No, just take 2 minutes to describe to our team what prospect theory is, because I think this is important in not only making a decision on directional trades, but when you're making a decision on whether to buy back that call option at a loss. So talk about prospect theory just a second.
Right. Prospect theory is it's a psychological theory. It's a behavioral economics piece from like 1979. They won the Nobel Prize in economics for it. And it comes down to, we'll call $0 break even your frame of reference. And you can look at they graph out the amount of pleasure or psychological value people get from winning. And the graph looks a little something like this compared to the amount of psychological value they feel for the same amount of money they're losing. And the graph looks a little bit like that. So if you make $100, you feel it this much. If you make $200, you feel it this much. If you lose $100, you feel it, this much. If you lose $200, you feel it this much. Like you feel a huge, there's a heavier psychological value to a drawdown to losing than there is to winning. And this kind of speaks to how we're wired in our brains. What happens when people start to get drawn down is they become risk seekers. They become a little bit of a gamblers. They have a harder time ripping off the Band-Aid. And then, the return value, they become impatient with their profits because they're not going fast enough. They just don't feel the gain as much. And I think it's probably the hard wiring in most people's brains that they have to rewire that, find a mental hack to get around it. And I think the simple answer to that's always like, using a stop loss. But we are not psychologically wired well when we start to experience loss aversion. So closing out like a covered call when you're down, even though you're winning on the stock, we have such a hard time taking the loss on the call that we might prohibit the potential gains by rolling it up.
But think about that, Noah. Even though you're making money on the net trade, on the net investment, because you always make more money on the growth of the stock than you lose on the short call, people still have a hard time buying back that call at a loss because I can't do it. It's at a loss. But you're making money. You're making the right decision. But I want to say this about prospect theory. Prospect theory, and thank you so much for just kind of walking through the basics of prospect theory. But when you're looking at a loss versus a return, our psychological mentality changes, and it might be the exact same dollar figure. You're making $100 versus you're losing $100. But when we're making $100, we're fairly quick to lock in that profit. But when we're losing $100, we're not quick to lock in that risk because we don't want to take a loss. And so when we're losing money, what prospect theory states is that we're going to go down to our bare bone basic instincts. And when you don't have a lot of experience in the market, you look at that short call on the covered call and you're like, oh, I can't buy that back because I'm going to buy it back at a debit and I'm going to take a loss. Well, what's the right decision to make? And based on the momentum of AMD, for me, if I don't want to be called out, which again, if you're concerned about it, get called out, rebuy, reset up. There's nothing wrong with that. But in terms of this decision, for me, I still think the best decision is to roll up to 30 or somewhere around that ballpark, depending on what delta you want to use. Roll up to 30, reset that call option. If it goes to 30, so what? You're still making more money on the stock than you are on the short call.
Yeah, well, and the thing about that is even if you roll the call up and the price does retrace, you can always roll it back down and profit on that call. So if you're holding the stock, particularly for the gains, and you want to do your cash flow around that, you do need to allow for the capital gains. And so the idea of rolling up, I think, makes a lot of sense because again, otherwise you just get called out and you don't benefit from the rise in price.